and welcome back. This is the final episode of season 4, which season 4 was a ton of fun. We were actually on site in Washington. This particular episode is about, let's see here, it is January. So we're about 5 or 6 months removed from our time on site. And Spencer's going to talk about why that is. But I'll just say before we jump into any of that discussion, the season was a ton of fun. It was a ton of fun for me personally to have a bird's eye view of the project, of watching two professionals go at it in terms of, just analyzing, evaluating these models. But today we're actually going to walk through the actual model that is constructed for Deer Park. So Spencer, before we jump into the model, maybe talk about why we are removed 5-6 months from our time on site, and then what we're going to be doing today.
Yeah, thanks, Sam. And as a recap, Michael is launching a national development strategy, and he has his first development in the Pacific Northwest, just outside of Seattle. And so this season, we talked through some of what Michael's learned and some of our own experiences. We also delved into other areas like super forecasting and AI. Nevertheless, as we came back from Washington, as it went into production, as is the case with all development, I spent the first 10 years of my life in development. This is the case with all development, almost weekly, up until the point where you really break ground, things are just constantly changing. And enough change for Michael's first project around economics, around timeframes, that the last episode we recorded on site, where we dug into Michael's model, and I pretended as if I was an LP, and I was vetting his assumptions and pushing back against certain conclusions. Those assumptions have changed sufficiently where we decided we would just go ahead and re-record this in a virtual fashion. So I think the first point, I'm going to put myself in the shoes of an LP. I spent a portion of my career as an LP, putting LP capital into developments such as what Michael has underway in the Pacific Northwest. One of the first things you ask, even before you get into the numbers, is what's the story? Like, why even do this? And there's a story at, call it the strategy level. Why apartment development if someone's in an apartment? Why hotel development, right? And then there's a story at the asset level. And so, Michael, I guess the first question for you is, what is the strategy level story here? Yeah. And to help with that, we're going to share a screen, and you'll see just some notes that Michael has made as he's prepared his strategy. So pretend, Michael, like I'm an LP. Explain to me why this even makes sense from a strategy standpoint.
Yeah, well, let me even back up just a little bit before we go right into the strategy. And this is something I learned. It's funny. This is something so simple and so intuitive, but someone had to hit me on the head with it to really bring it to the foreground. And I want to discuss a concept that I picked up actually at my time at Stablewood and working directly with Glenn Lowenstein, who is the CEO, founder of Stablewood, and where Spencer is today. It's something we all think about. We all do it indirectly. And I want to just make this very clear for anybody out there that's thinking about doing an investment strategy, whatever it is. No matter how sophisticated or how complex your strategy is or how simple it is, it all comes down to a basic fundamental concept. And that concept is this: demand has to be a lot greater than supply. It's part one. And the second part of that is that there has to be attractive pricing. So you can have demand greater than supply, and if everybody's in there trying to buy, and this is something that's happening in the multifamily space right now, where there's just so much competition that yields kind of squeezed out. And yes, you can still go, and if you're a long-term investor, it might not be a problem, but yield has been squeezed because there's the attractive pricing piece is missing from that. So that is a concept I've taken, and you think, oh, supply demand, everybody talks about that. But just having it said to me that simply, and that's the beauty of people who have gotten so successful in any industry is that they could take concepts that you might, I'm going to use the word complexify, if that's even a word, and they can boil it down so simply that they can communicate it so effectively that that's the model of that's how success permeates. So a lot of these people that I've seen and I've met over the years, and Glenn Lowenstein is one of those people. And when he said that to me, I was like, man, that is just so simple and so basic, but it permeates. And I left Stablewood back in July, and I had gone through a couple strategies, deep thinking long and hard about opportunities. And this opportunity and larger strategy smacked me on the forehead. This project in particular, which we'll get into after we talk about the major strategy, is one that's right outside of Olympmic National Park, and it's an RV park. And the macro strategy here checks all the boxes. So, again, you could be a Stablewood Properties where you're out there using the most sophisticated tech and data, or you could be a simple mom and pop investor. If that fundamental holds true, you're going to do well. And here's the strategy that I want to share with everyone that is currently in that state of being, so to speak, where demand is greater than supply and you have attractive pricing. And we'll walk through at a macro level here first with this presentation, which is what I wanted to share to show you that. And it's very simple. It's a couple graphs. There's nothing complex about it, which again lends to the idea and the validity of this idea, is that you don't need to present this complex concept to get to the point. It's just all smack right in front of your face. So what I want to show you here in this first slide is a slide that it talks about demand, which is the first checkbox in this broad and simple concept. So here you have, and again, we're talking about the strategy, which is RV parks and campgrounds. This is not manufactured housing where people come and they stay long-term, which there's another strategy that is viable today also, but we're not going to talk about that. This is transient. Think of hotels where people are showing up with their RVs, and they're staying and they're leaving. This is not long-term. This is transient RV parks. So this first graph here shows a growth in annual active camper households. Now, I'd like to hone in. Before I even go in, any questions, comments, things you'd like to add, Spencer?
No, this is fine. So this is the demand side of the demand exceeds supply at attractive pricing. I see it's active camper households. How does it relate to RVs, or are they one and the same?
So we are going to hone in. So between RV parks and campgrounds, the idea is that there's this outdoor hospitality sector that is, from the institutional perspective, nascent, but it is growing rapidly. And so what I wanted to show you at the macro level before we hone into RVs is this growth in active household campers. And we can hone in really, let's talk pre-pandemic 2019 to 2022. What you'll see here is this dramatic growth of 42 million to 58.5 million households that are camping. Now that's a very interesting number in and of itself in the large scheme. You're taking 42 to 50, that's 16.5 million new users over the last, new camper households over the last 4 years. But what I found particularly notable is if you go to the sticky customer base, let's call it, which are these 3+ times a year, people who have really grown into this outdoor camping, RVing type concept and continue to do it and are doing it multiple times a year, that has grown from 18.9 to 28. So 9 million plus, a little more than 9 million new active households just within those last 4 years. So when you think about the demand, that was a first sort of green light to say, okay, that's interesting. Has supply caught up with that, right? And to me, when you think about development and bringing on new product, the likelihood of being able to accommodate 9 million new households or camping households, when the original number in 2019 is 18.9 million, seems unlikely. You've almost doubled the amount, or you've almost grown it by 50%, the amount of new households.
You know what else is notable, Michael, if I can stop you? So one could argue that the jump from 2020 to 2021 is purely driven by people who are stuck at home and there's no other alternative. But what I find interesting is that you get from 2021 to 2022, a period where things really opened up, and in particular 2022, where the world was largely open, and the one-time users actually fell. Not quite to the 2019 level of 5 million, but it fell. But the sticky piece, exactly. 25.6 to 28, increased. And what that says to me is people discovered outdoor recreation, whether it's RV or whether it's tent camping, and they liked it. And so because they discover this new thing, it becomes a new norm. And so you could argue, and now I'm not playing the LP side, but you could argue that this will remain at the new levels because of the introduction to a new way of recreating that people perhaps hadn't tried before.
Right. So now we're kind of warming up to the demand side. The demand side. Now the next slide gets to an even stickier customer base or user of this type of space. So what you have here is growth in RV households. Okay. So the blue is active camper households owning RVs, and then RV households. So these are people who prefer RV camping. I want to now, while both are attractive and interesting, and you can read the slide, I'm not going to read it for you. And I'll share this. I think after we do this, we can put this document up. It's nothing proprietary. What's really interesting to me and fascinating and exciting is this growth from 7 million to 12 million active camper households owning RVs. So you had, and whether supply was meeting demand in 2019, there were 7 million households owning RVs. You've added 5 million. You're not exactly 2xing, but you're close to this new RV owner group that now has an RV. They've owned it. They've significantly invested in this type of activity, and they have these RVs now. And so they are looking for opportunity and places to go. And you've doubled this new demand driver, right? So now these people own it. It's sticky. They're invested now. They own these RVs. So that was another green light for me to say, okay, this is now even becoming a little more compelling, right? I'm kind of leading you down the path here on the demand side.
So help me understand a little bit more, though, about the options that RV owners have. So let's imagine, I'm not an RV household, by the way. But let's imagine I was an RV household. I've got an RV in the side yard. What do I do with that RV?
Yeah.
So describe. I mean, many on the call probably do know, but those who are listening don't quite understand what the options for an RV owner are. What are they?
Yeah. So if you think of RV, I'll be very basic here. It's a house on wheels that you can take, and it's varying levels of comfort. You know, you can have your Class A, B, C motorhomes. Your fifth wheels that you connect to your truck. And it's just a way to increase your comfort when you're going outdoors. And I'm being very generic here. But you take these things to go experience outdoors, right? And it's really made to help you be more comfortable when you're going out into nature, so to speak, you know? So you can take these things locally, and you can go, maybe there's a campground there's a lakeside campground. There's things like that are more local. And there's a lot of those options where, you know, for me, I'm right outside of Philadelphia, and between Philadelphia and New York, there's the Poconos, right? And a lot of people will go and bring their RVs up there. And a lot of people just take these things around the country. You have people that use them sort of for vacation, and they'll park them either in RV storage, which is another interesting, you know, asset class in the real estate space. Or you have some people who live in them more full time, and they're retired. Sometimes it's like retired couples, and they'll go out and they'll do cross country road trips, and they'll stay at different RV parks. So those are sort of some of the options out there for people who own RVs and what they typically do with them.
Got it. Okay. So you want to get to the supply side now?
Yes, let's get to the supply side. So what's really interesting about this space in general, so what you're looking at here is really the first national campground supply, the results of the first national campground supply demand analysis that I think was ever done by RVIA. And that says a lot if you think about this. When you're looking in the RV space, you're not getting CoStar reports. They're not available. You're not getting STAR reports as in like the hotel industry. This is an industry that has tremendous opportunity because you don't have this sophistication here yet, and you don't have the institutional money that's flowing in here, driving up prices and reducing yields yet. Now it's on its way. There's a lot of interest in the space, but it's not there yet. So what you're looking at here is one of the first studies done in 2021 that really kind of looked into the macro supply side of RV parks. And what you're seeing here is, and this is not in pristine bucket list national parks, which is where we're going. This is across the country. So you can take the most plain RV site that's off to the side of the road down from your neighborhood, and this is capturing that. And what you're seeing in peak season is 76% occupancy. Now, if anybody that's in the hotel industry, you know, if there's 70% plus occupancy, it's time to build new in any market, right? There's room for growth. And here what you're seeing is you're above 70%, you're at 76% according to this study. And this is nationwide across the country. Annual 54%, very healthy. And then, you know, this is nationwide. So then you go and select the markets, you're looking at even higher occupancy. So again, another on the supply side now indicator, okay, incredible demand, inadequate supply. And now you ever see it with a guy from WWF, now WWE, like the Jim McMahon, this meme where like he's sitting in a chair and then he gets like more excited and he gets more excited. And the last one he's like exploding. Do you ever see this meme before?
Yeah, oh yeah.
Yeah, so that's kind of like where I'm at now. I'm at like the third still of that meme right here when I see this.
So what data, if at all, is there around growth in supply? So we have a 2021 analysis here that shows that you know you have strong demand supply dynamics, but I mean, is there 2019 data? Is there 2012 data where you can compare the growth in demand relative to the change in supply?
Not that I have found at the macro level. And now here's where like a bit of sophistication gets involved because there isn't really perfect information out there that you can easily access. And we'll get into this when we get into the model. So, okay, fine. This is all well and good at the macro level. To your point, how do I believe my story when I'm going into bucket list national parks? So yeah, what's happening right now is I am getting, we all should be getting a feeling that there's great opportunity and now it's time to dive in deeper. And it doesn't necessarily, from my perspective, need to be on the national level, but at the market specific level, yes. Okay. Here's now it's time. It's worth the time to keep going, right?
Got it.
But
Got it. Okay.
I don't have anything previously that said what was it before and how is the trend going there. At least that I have.
So you're really describing, and for the listener, Michael's strategy is developing RV parks in and around national parks. He calls it RV at. So his first project is RV at Olypmic. And what you're describing is you saw this national trend and your assumption then went to, and I'm assuming you have data to then support your assumption. Your assumption then went to if demand at the national level, including all these ancillary, less interesting locations, if the demand supply dynamic is so strong, imagine how much stronger and better it is at the premier locations like Olympia National Park.
Exactly. Correct.
So what are we looking at here?
Yeah, so this is something that I pulled from DYRT, D-Y-R-T. They have over 30 million visits annually. They do a lot of bookings for campgrounds and RV parks. And these are just pulled out some of the notable findings from really that validates this supply-demand imbalance. So 58.4% of campers surveyed had trouble finding a campsite in 2022, which is a 5x increase. The percent of campers who had trouble finding campsites compared to 2019. And then, you know, a little bit more data, camping on wheels, roughly 51% are camping in vehicles. And these people are 50% more likely to camp in winter. There's the seasonality aspect. So whether you're doing campgrounds or RV parks, and then 20% more likely to report difficulty. So these people who we are catering to are having a subjectively harder time based on this survey. So I thought it was notable to
yeah, that is interesting. So it's not the sort of data that in the major asset classes we have in real estate that has, you know, down to the number of units square feet of office, units of multifamily over the last 30 years. But you have a survey here that points to a supply issue. I live in Colorado. I'm an avid outdoors person. Love to camp, love to backpack. It's virtually impossible in Colorado to find a campsite. When I grew up in Idaho, on a Friday night, you'd go, well, let's go camping, and you'd go up and you could pick. You had the pick, right, of where you wanted to go, and that's just not, at least in Colorado. And I think Sam, who's in Idaho, can speak to it. That's just not the case anymore. In fact, my son and I generally will backpack because we don't have occupancy issues there. But just an anecdote, but this survey does ring true for me.
And that's sort of when you about the national.
No, go ahead.
Yeah, when you get into these niche opportunity spots, like I've had the same experiences. Like I've gone cross. I've visited a ton of these national parks, and we have the same challenges. While the data isn't there, because you become more engrossed in the community. There's opportunity here, and it's sort of how these things evolve over time. Even when you think back to the Hineses of the world, like when Gerald Hines was building his first office towers, he knew, like they call it like the big wave of office, right? That anybody could have built office in any major city at that time because there was just this macro wave of white collar workers coming in. You maybe didn't have the data then, but you were in the community. Speaking of Gerald Hines, he was in Houston and knew what was there. And it's almost that feeling where, yes, when you're presenting to somebody, this isn't probably the best to present to an institutional investor, but it's telling a story that's here in absence of the perfect data that's just not here yet.
Well, that's why you have attractive pricing, right? So in obscure markets, and obscure is probably not exactly the right term I'm looking for, markets where there's a scarcity of information.
Yes.
The lower cost capital is less likely to come in at that moment in time until the world becomes a bit more stable in a given market. Self-storage, take as an example, up until the last 5-10 years.
Single-family rentals.
Single-family rentals, another great example. And as those became more mature, institutional capital flowed in, cap rates compressed significantly.
Yep.
And so what you're describing is a property type that feels very much like, to me, quite frankly, multifamily in the early 2000s was still a relatively nascent property type. Believe it or not, I mean, it's incredible to even imagine. But institutions were not heavy in multifamily in the early 2000s like they are today. It was all office and retail back then.
And there's another, while it's not exactly manufactured housing, the concept of standing on the shoulders of giants or following the giants in. I mean, 20 years ago, Equity Lifestyle got started, which was Sam Zell buying trailer parks. Now we call manufactured housing, but they have a significant percent of RV too. And if you look at the public REIT and you look at their data and their returns year over year, he wasn't afraid to get into this niche area, and you see him trailblazing. And so, and even though it's 20 years ago, it's still early here. And I got quite excited. So, you see somebody like that coming in, and then you're seeing the data to support it. And then the growth, for better or for worse, when COVID hit, this just incredible growth, it seems to be sticky and it's being validated because now we're in 2023. And I have data that supports 2023 as an even stronger year for national parks than 2022 was, and the data's out. You can go and look at the national parks there. But anyway, we can keep going.
So let's talk national parks then. So this is the last piece of your demand exceeding supply.
So this is my own cultivation of research that just points to, now you're seeing a study that I put together, so to speak, with more higher level information, but has come to ring true for the parks that we went deep on. This anticipated or expected without the CoStar reports and Star reports to tell us what their occupancy levels are. The more we dive into
the national parks, let me just ask some clarifying questions. These are national parks that you're targeting?
These are a handful of the national parks that we are targeting. After doing a lot of studies on all the national parks, these are a handful of them, yes, that we're
And this is the occupancy rate of RV parks within a 25-mile radius of each of these national parks. And it makes sense that you've got peak season. Certain parks have a longer peak season because of weather than others. Olympic is where you're at. So it looks like because Olympic on the Strait of, what is it called,
Juan de
Sam?
Fuca.
Juan de Fuca. Yeah, Juan de Fuca.
You don't get snow, I would imagine, at this park. And so,
no.
But you still have a relatively low occupancy rate during the colder months. And as you hit middle of the summer, people are out of school. Is that what's going on here?
We deduce this based on now what's not include. So first of all, let me just back up a minute. You're getting things where you see, like if we look at Grand Canyon, for example, it's like fully occupied. It's not only that the park is open or closed, it's that there's just some impossibly high barrier to entry. Like Grand Canyon, I mean, you're likely never going to build a park. Yes, well, we'll target it. I mean, the likelihood of us finding land there, like that's one. But to the other ones, yes, we are, in my opinion, and I've looked deeply at Bryce Canyon. We had a deal that fell out there, but we know it. Olympic National Park. These are areas that I believe we've validated in terms of their occupancy rates.
Got it.
What's not included here is that, so we did a study. I pulled in a ton of data. I pulled in all the parks within 25-mile radius of the main entry points of all these parks. And we literally went in and counted every single site. We deduced how many people come. And I have the study, which I'll share with you guys. What's not included here, some of these parks that are in here, the supply in this study that's here is arguably oversupply, because what we found in Olympic and Bryce is some of these are actually mobile home parks where you're not staying in, but they're included in there. So once you refine the data a little more, it actually becomes a little more supply constrained. But again, this was a directional study to say, does the macro thesis hold true? And the answer was remarkably yes. And as we've gotten into the first couple deals that we've went after, it's validating.
So let's talk now. So the macro story makes a lot of sense. As an LP investor, right, or playing that part in this conversation, I would acknowledge that. Now, I might take issue with the management nature of, you could say, it's a heavier management element to this, more akin to, not quite hotel, but it's not hands off like other property types. So there's a management component here. There's also the seasonality that might get me as an LP uncomfortable, but ignoring that, because that's a whole different piece. And one gets comfortable with this because the overall story works. Let's dig into to your first deal. So if I understand right, you own the land, you are fully entitled, permitted, and ready to build, right? And you expect to build, we're in January 2024 now, you expect to build this year.
Yes. Yeah, our goal is to build this year. Yes. And when we recorded this last time, we had a big hangover, which was, so this county's Clallam County. Turns out we have the largest septic system in the entire county, and it was a little bit of a what we thought was going to be like a checkbox sort of, okay, let's go, became a major issue that pushed us out, and we had to commission a study, and which happens in development all the time. So we're over that, we're fully entitled. Everything else is sort of refinement now, but we're fully ready to break ground, which is very exciting. We're all super happy.
Again, I'm going to continue to play the role of the LP. This is how I think about now the numbers. All right. So I believe in the strategy. I believe in the sponsor, the operator, and Michael Cornell Hines Train, spent some time with Stablewood, well capitalized and all that. Right. So I bought into the strategy. I bought into the sponsor and the operator, the developer. And now I want to say, okay, does this deal actually make sense? When I say make sense, what I'm really describing is, do I believe the assumptions? Because a developer is not going to bring me a deal as an LP unless the numbers look good. And so then the question is, do I believe the assumptions that ultimately lead to those outcomes? And I start with the project budget. right? Because there's really two ends of this. What's the stabilized income this will produce relative to the project budget? I divide that by this. That gets me my yield on cost. And I say, what's that number, that yield on cost? How does that compare to a stabilized cap rate in this space? And if there's sufficient spread, we call that the development spread between those two, to compensate for the risk of the development, then it's worth doing. Right, so that's how simple this analysis is, and so now it starts with project cost. So,
allow me, if you don't mind, allow me to break the fourth wall for a second as well. So and this is true, like this is happening right now. I am the GP, and I am presenting these numbers, and these are real numbers here. I have to take all my data, and as a GP, I want to be as aggressive as possible. But as me, Michael Belasco, I need to be, and maybe any other GP, I have to be realistic because I need to be able to really sell these numbers, and I always battle between what the data says and my conservative. I'm naturally a conservative person. And so the dynamic here is a GP is aggressive, an LP is conservative. And a good GP in my mind is honest and as conservative as possible. And I like to think that that's what I'm presenting here. But that's sort of the dynamic from the GP.
Yeah, that makes sense. So the other thing I'll say, if you're a newer LP listening to this, the closer you are to the go date, the more real the numbers get, and especially on the project budget side. And so when I look at these numbers, Michael, land value, a hard cost, which includes a whole variety of subline items, marketing, development fee, how many of these are fully bid out? Meaning you have commitments from subcontractors to perform at that price.
Yeah. So we bid all of these out. However, when we bid them out, it was in December of 2022.
Okay.
So we've been having ongoing conversations. This has been taken, we've been getting the approvals and we've engaged. So we are about 13 months out. Now, however, we've been engaging and we've added escalators, even though we've grown the price by a little bit for each one. All of the subs we've talked to have told us the prices have held relatively the same. They've all been bid out. They know what they're doing. We've gotten the details out. However, we're again, 12, 13 months over, but we expect it to be roughly the same. And I think this is conservative. We've upped all these numbers, and anybody that's taking a hard look at this will see the original bids and the difference between them. But every sub has looked at this project and created a plan and strategy and bid it out. It just happened 13 months back.
So there's some uncertainty here because you've got 12 to 14 month stale sub bids. Your argument is that, and by the way, it's largely backed by numbers. There hasn't been a dramatic increase in construction costs through 2023. Most of that happened in 2022. In some areas, there actually have been some reductions. Correct. I hear you. Nevertheless, if I understood right, you have included some escalators.
I'm rounding up. So anybody that sees these actual bids will see these numbers are rounded up.
They're rounded up. Okay. And then you, on top of that, have your contingency here,
correct,
which theoretically could provide for that. I would imagine before you finalize your capital stack, well, certainly before you finalize your capital stack, you'll have updated bids here, which will cause them to change, move up or down, depending on.
Yeah, the goal is to re-engage the sub. So right now we have about 27% of this budget invested. We've already put it in. The money's there.
Okay.
We want to re-engage the subs. There's an expectation that this will not change much, and the idea is to get that capital partner aligned, get ready to go, re-engage the subs at that point all in that time. So that's
okay. So that's the first thing that I, as an LP, look at. I want to understand how real this budget is. And in fact, if I were investing with Michael, I would say that's all great, Michael. And before I formally fund here, before I formally commit, I need this budget updated.
Yes.
And he'll say, absolutely, yeah. All right. And assuming it doesn't exceed some variance, I will likely commit. And so I might say, okay, as long as the budget doesn't change by more than 5 or 10% from this stage. And by the way, Michael may come to me as an LP a year before he breaks ground, and the budget always changes. Mm-hmm. Anyone who's been in this in development or construction know the budget's always changing. And so it's just trusting that there's sufficient cushion and contingency, and providing for as an LP, the ability to walk if things fall outside some variance. So let's proceed with this assumption that it costs $5.97 million to build this project. It's 100 units. And I know that because I look here, number of sites, 100 units. Here I have the property address and so forth. I see Michael has some assumptions around timing, which I'll dig into some, because timing matters to the extent that I'm calculating on my side, independent of Michael's calculation, my LP returns, and timing is a factor in my IRR at least. But I'm going to believe, okay, I got a $6 million number. Now, if I'm understanding correctly, Michael, you are contributing the land, and you are contributing all or some of your development fee?
We'll do 50% of our development fee was the goal. So it'll be 1.6 million.
So of a $6 million capital, a $6 million capital stack, $6 million of uses that have to be on the sources side. There's 4.4 million of LP equity or LP equity plus debt that would have to be raised, right? So I would as an LP be a portion. Maybe I put up the LP equity. Michael goes out and secures debt. If I understand right, Michael, and I don't want to get into this too much, you're somewhere in between doing this all equity or bringing in some construction debt, and it really depends on the market and the nature of that debt. Is that correct?
Yeah, we're gonna go, live with this. The goal would be to go the preference is to go all equity, and not have to deal with any risk on interest rates and, all that stuff. Although we're getting more comfortable adding debt, low leverage, debt on this project, depending what type of terms are out there. But yes, we are looking, because it's not such a huge all-in number, that 4.4 million, we're hoping to go in equity construction, refi out at stabilization.
Okay, so it's no debt to build, and then it looks like you stabilize. You begin operation January 2025. How long from there until you expect to stabilize?
Yeah, the goal, the likelihood is that we'll have to get a season in of, to show how the year went. And then from there, you have your first stabilized year in the books, and then you go and refi there. So my expectation is we get that whole season in. Come October, we hit the market for, depending on how the structures that we've worked out, if we do get construction debt, but the goal is go to the market and, August, September, start to warm people up, and then hopefully close on it by the end of that year, December or January.
Got it. So if I'm an LP investor, I'm thinking about it this way. All right, it's a $4.4 million check. The nice thing about going all equity is that we take debt risk off the table.
Correct.
The downside is that I can't lever my returns quite as much because debt doesn't come in until about 2 years after I fund. Now, at that point in time, and I've already read this model, right? So I'm just talking this through with the developer. At that point in time, all of my equity is returned. Is that what I understand?
Yeah, so if you scroll up a little bit to the top and you go to the top right, go up a little higher. So right here where it says business plan, which there says develop with all, I'm in column F, by the way. Develop with all equity, 5.9, refi stabilization, proceeds back from the debt, equity remaining in deal. And by the way, this model will be on the site, and if that wasn't the case and there was equity, that would show up. And then average cash flow to partnership afterwards, and then average annual cash on cash, if there was equity left, would display there.
And so at that point in time, your promote would crystallize, and I would stay in long term at some or what do you have in mind for me?
Yeah, if we hit that, it would crystallize there, and then the goal is and if it doesn't crystallize, the goal is to keep going pari passu on the ownership structure all the way out until exit.
Okay, so either there's a crystallization at that stage, or you buy me out at whatever value it is, or I buy you out, or you planning to stay in this long?
No, I'm hoping to find a long term. Now, I guess if we exit out and the debt covers whatever the required return is, that's a conversation. But our goal is to go long term. This is a 10-year.
Okay, so this is a build to core. I crystallize your promote at refinance, which makes that makes the most sense. Your promotes crystallize at that point, and then we me as LPU as the sponsor continue to hold this long term. That makes a lot of sense. And so again, from a teaching moment, what I'm looking at is, okay, how realistic is that? And it seems like the construction period is realistic. 9-month construction duration, considering it's an RV park. What do you have?
Yeah, it's all horizontal, meaning you're doing the utilities underground. You got to build the septic system, and then you're putting pads. And these pads are gravel, so the road's going to be paved and everything, but they're gravel pads. And so constructions, there's no vertical. Now there is a like a welcome center, a building. I believe it's roughly, I might be getting square footage off a little bit, about 2,000 square feet. It's nothing big. It's a basic concept. And there's another bathhouse that's being built, and then amenities. So all of that is not intense. You're not building a high-rise or garden-style apartments. It's very, straightforward, horizontal.
Okay, so a 9-month construction period makes sense. And then you have a year of operation before putting debt on. So again, from my standpoint, I go, all right, I feel comfortable with the project cost. Let's dig into then the income and expenses.
Yeah, you scroll over operating assumptions there too if you want. Oh, but yeah, you can do whatever you want.
What was it here on the summary tab, right? Oh yeah, okay. So what I see here, and really here it's all about revenue and expenses that come down to my NOI, and my NOI I divide it by my project cost. And the question is, how realistic are those income and expense assumptions? So the biggest, most important number is the rent, in this case, the average daily rate, the occupancy rate, which you'll have to show me where I can find that, such that we can get into other income, which other income can move the needle. But what I'm seeing here is you have a $62 average daily rate and a 68% average annual occupancy. And it looks like on your monthly cash flow is where that is. How do you get to 68%, I guess, is what am I looking at? Monthly,
so why don't we go, there's a last tab here, supply versus demand analysis, and I can kind of justify how I got comfortable with 68%. Okay. So just focusing down on this bottom piece with the green header.
Yep.
This is where you have to take a lot of time, and I had to take a lot of time and really dig into some research and pull some numbers from places I trusted, like the National Park Service data. RVIA is a really great, reliable source that provides data on the RV industry. And I backed into this sort of monthly anticipated occupancy based on, now this is where it differs from the big model that I showed you, based on truly comparable product types, which to me is modern, full hookup RV sites. The interesting thing with Olympmic National Park is that there's really one, and I mean that, anybody that's interested, we can go do the tour. There is one really truly comparable RV park out there. The other ones that feel and seem comparable when you go out there, they're not even close to a modern RV park. So the supply is very dated, and so it's not even close. So if you see at the top here, I have a total comps in the market, which is 834 sites.
That's sites, okay.
And these are within 25 miles, okay? And you can argue, and Sam knows this area better than all of us, some of these are out in Squim, which you could almost say is a little even too far, but I needed supply, so I kept them in. I wanted it for conservatism. And I know sure. I'm not making a sales pitch as a GP here. There's a map. If anybody gets the OM, you can click on the map and see where these are. And you can see one of these parks is even a parking lot outside of like a roadway in or one of them. Honestly, that's what you have here. Anyway, so total comps in the market, 834. I'll just walk you through the math real quick of how I backed into this, okay? So take that. This is how many sites are available out of the year. If you were to take these 834 sites, which span over 11 different parks. And that's it.
And that's on this comp set tab here,
That's right? On that Rev comp set tab, correct.
That Rev comp set, okay.
Yeah. Right here. These are the parks.
So you multiply that by 365 and you get 304,000.
That's what you have every 365 days a year. That's what you have available within 25 miles. So now we have our supply side, and then you have to kind of figure seasonality and all that. But anyway, that's your annual supply side. And then I pulled out, what I was trying to get to was how many RVs are coming to Olympmic National Park. There's no data that calculates the RVs and what they're doing there yet, right? So I took the total national park visitors in the country, and I took the total national park visitors at Olympmic, and you get this 0.9% of all national park visitors are coming to Olympmic. Okay, so hold that thought.
Okay.
RVIA comes out with this great study every year. They say this is how many people are traveling. This is how many people are traveling in RVs. This is what percent of them are visiting national parks. This year, 2022, I believe it was like 58% or 60%. The one assumption I had to make here was, what's the average RV household size that travels in an RV? So this is one you could play around with. Any LP investor, I'd encourage you to mess with it. Like, you get comfortable yourself. This is how I got comfortable with it. So from that, I said, okay, using that 2.5 average household size of the 39 million, number of RVs to visit national parks, 15.6 million. Estimated number of RVs to Olympmic, 142. Taking that 15.6 and multiplying it by the 0.9.
Got it. Okay.
So I had to come up with some math to say, okay, is this reasonable? I looked at these studies. They're as reliable as possible, so as they can be doing national studies. So I said, okay, now I have hard data from NPS, which is what's below. This is the seasonality. So starting in row 12. If you take all the national park visitors, they release it by month. So 3% of all visitors that come to Olympmic in 2022 came in January. February, 3%, March, 5%, so on and so forth. Okay?
So this adds up to 100, and this is the proportion of visitors in each month.
Correct. So then if you go down, now I don't know how long people are staying in Olympmic. Now I know, me coming from the East Coast to Olympmic, I'm staying for at least 3 nights, and people go to this national park. It's not a one and done thing. You don't just go there for a day in your RV and leave. You go there for a couple days, right? I did a sensitivity, if you go down to row 27, on, okay, what if the average is 2 nights? What if the average is 3 nights? What if the average is 4 nights? And maybe click into one of those cells. You can kind of just see a formula just so we kind of get where this occupancy is coming from.
I see. Okay.
So so you can kind of, if you see, so if it's 2 nights, you have all these room nights. What's the average occupancy? And the trend follows what the macro says, right? But now we've refined it. We've picked out the true comps. Even if there's a site that's like a Class C site available, an RV at Olympmic site's available, people are choosing this site over that other one, right? So I got this degree of confidence. First of all, we're the second closest RV park to the entrance of Olympmic National Park. And we're going to be the most modern. So even if these numbers, you could believe they are aggressive, if anybody had a choice in RV park to stay around Olympmic, it's going to be this park based on the quality, the vintage, the amenities. So nonetheless, this is how I got comfortable with our occupancy, which I put at 68%. So it's under the 3-night average of what I got here and a little above the 2-night average. So I said, okay, if this feels aggressive, I'm going to err caution. Now, we are the best new RV park in the area. And so therefore, I would argue it could get higher than 68%. So
so you're assuming just a 68% occupancy. It could be higher than that based on that analysis you did, which makes a lot of sense. I see that you have no utility reimbursement. So any utilities used at the site, which that makes total sense, is included in the 62. But how confident are you in the $62 rate?
Yeah, so go to the revenue comp set tab. Okay. So I had to get comfortable and confident, and this is. So I went and looked, and we checked seasonality. So we looked at all different dates for all these. So, for example, when we look at Port Angeles KOA, we'll look in January, April, July, December, and we look at the full hookup sites only, because we don't have any partial hookups. We are 100% full hookup, and that's how we deduced what are these guys charging for their ADR, average daily rate, which is a common hotel term, and I'm learning not as common yet in the RV space. And look, KLA is charging $66.50. They're further away. Our amenities are going to be just as good. Everything that we have is going to be comparable to them. And I still am, in my mind, being conservative. Partly because when I look at the returns on this, and we've vetted everything, it just feels like it's incredible. And this is the demand greater than supply. And wow, attractive pricing. It's like really attractive pricing. So I said, okay, fine. If I went to 66.5 and tried to put that in the model, like the numbers go crazy, right? So I went back to 62, and you could argue I'm pushing back on myself, but that's fine. I'd rather under promise and over deliver, and I feel like that's what this is doing.
And if I were to just to do on the fly sensitivity, and I look here on my return after promote and asset management fees, right now I'm and this is a 10-year hold, I believe.
Yes.
Right. I'm a 31.5% IRR, but really it's on this deal, I'm really looking at multiple, right? I'm a 245 multiple. If you're only able to get $50 or a $50 ADR, I'm still almost a 2 multiple.
Well, that multiple is also misleading to the conservative side too, because you're going in, this is something really important. You're going in all equity on your development.
Oh, that's true.
And so you have this weird thing where you're putting out all this money, but then all of a sudden it disappears. And really your equity multiple is infinite after that point. And everybody that, and you know this, Spencer, we talked about this. We've had projects we've worked on where we were like, we were rattling our brain why the equity multiple was so off. But it's when you're always going all equity and putting debt on after the fact, there's a little funny thing that happens with the equity multiple. It should be higher, but it is that, and it is attractive even with that weird anomaly.
Well, to that point, we released a blog post last month on a concept of a weighted equity multiple, right? And what that's meant to do is account for this very thing you're describing, which is it's really not fair to say this is actually an equity multiple on a weighted basis that's higher than 245. And why? Because my equity is actually only out for 2 years, and yet I get the benefit over 10 years. Well, what am I going to do with that equity for the next 8 years? It's going to go into a different investment that will likewise get some multiple. And therefore the 245, okay, so that makes sense. So what you're really saying is, hey, if I go a whole lot higher than 62, the numbers just become unbelievable.
Yeah. I want to sell this thing, and it's like, okay, guy. When you're up so high.
Let's dig into the expenses. So that's the revenue side. How confident are you in these different expense line items? What tools, what data are you using to support things like, insurance, payroll, supplies, taxes, and so forth?
Yeah, well, in insurance, we actually got a direct quote from an insurance group.
Okay.
And we went through all the details. It might not be in this model, but I have a model where that's worked out. And we're actually, we're a little higher than what we think the quote's going to come in at. So that I feel very confident in. The other numbers come in from, what started as a macro study from this broker out in the Southeast who's been an RV park broker since the 80s, and he developed this study, and it's all different RV parks, and he aggregates them into parks that he sold for X amount of dollars, whatever, and there's maybe 20 or so parks, and he sells this report that shows their operating expenses as a percentage of revenue. That was my starting point, right? Being new to this space. And then through our conversations with some groups, we have the benefit of knowing some institutional people in this space. We met 2 property managers, which we sent them, even paid them to review the model and make sure that these are accurate. Both of which are in the Pacific Northwest. Both corroborated this was on target. And then we have a 3rd property manager who we're going to be bringing on likely actually out of the South. But who's a great property manager, also corroborate the numbers and validate them. So we've had a bunch of people that do this every single day as property managers and vet and give their seal of approval on these numbers. So
if I dig in, I look at your first stabilized year, that would be year 2. I see 1.7 million of effective gross revenue against 734,000 of expenses. So I'm going to look at the expense ratio, right? And that's 43%.
Yeah. That line right below, you got it there.
What's that?
Your OpEx ratio, row 51.
Oh, you got it right there. Yeah. So your OpEx, so you stabilize at about a 43% OpEx ratio. Looks like your taxes are about 10% of your OpEx, which I don't know Washington as well as I do other states, but that seems realistic. Hospitality, the expense ratio is really going to depend on whether you're limited service or full service or something in between. But 43% does not seem out of the realm of realistic. Again, I don't know it like you do, and it sounds like you have consulted with people that have helped you come to a number that's realistic. So I'm looking at an NOI, in fairness, on a trended basis. 2 years in, 3% growth, I believe, was your growth assumption of just shy of $1 million. When we cap that at a 9% cap rate, that's the attractive pricing. Is that really what cap rates are in RV right now?
Not much has traded lately, but the cap rates we're seeing are actually they're actually in like they're in the 8. They're around 8 or lower from what we've seen trade. What I really triangulated in on, I have the sale comp analysis tab here hidden because I don't know that I can divulge that. If we can share it and blur out the names, maybe. What I really looked at to validate was sale price per unit, which I put in here in column I. And there are sale comps today that are there and surpassing that I have. Now there's not a lot of sale comps in Olympmic National Park, but the sale comps are RV parks next to national parks that rhyme with this, that have similar profiles.
Got it.
Now there is one down the street that is, I would argue, not even a comp. I think ours is much better. That has an asking price, hasn't sold. That's very attractive, at least in terms of us being in the space. But there are others that sold like in and around Zion and Arches that go north of this and kind of hover right around this. So we're 10 years out. Again, it's another like, is this too good to be true? Where like all the data is saying this should be higher 10 years from now, as long as the world goes.
This is a sales price 10 years out there. Oh, I see. And so you have I missed it. So your stabilized value is 11.6. That's that number that just shy of $1 million NOI divided by, looks like you have a refi cap of 8.5. I get it. So you're looking at $6 million project cost, $11.5 million stabilized value. This is when you take out permanent debt. That's how you're able to pull all of the equity out. If I look at this from an LP standpoint, and we're almost at an hour, and so I'd like to wrap it up if that's okay.
Yeah, please.
This is my view as an LP. A very interesting macro story. I love the fact you own the land already. And so you have 25% of the equity in this.
Plus,
and if we put debt on, even more than that, right? If I'm able to talk you into putting debt on, and that's ultimately up to you. But if you end up putting debt on, then you're raising $3 million of equity. You already have $1.5 million on top of that. No, you have $1.5 million of that $3 million.
1.6 total. We're all in
1.
if we're
6.
contributing
I would be half the equity. You'd be half the equity. So you have significant skin in the game. So I look at it, I go, okay, well, Michael's clearly committed to this. I'm not worried about that. He's got the experience. So I'm not worried about that. And an interesting macro story at the micro level, second closest property to Olympmic Park. That
6
makes
miles,
a lot of sense.
Right, down the road.
Where I see risk is I go, okay, can Michael operate? And I'm sure that you've worked through that. So I'm not suggesting you haven't. It's just in the interest of time, I'm just thinking through risks. Like, can Michael prove that he can operate? Number one. Number two, this is a less liquid space. That's why cap rates are as high as they are. And so I need to be willing to commit to a 10-year hold here. I'm just thinking myself, because I'm going to bank on this market becoming more institutionalized as technology enters the space, as capital seeks yield in places like this, where the phenomenon that's happened in single family housing and self-storage and some of the other more nascent property types are now institutional. I'm going to make a bet that this is going to become institutional. And if I make that bet, and I know that you don't want to do this because you don't want the returns to look any more ridiculous than they already do. I'm going to take the debt away already. Imagine that cap rates actually compressed and you went to a 7 instead of a 9. It starts, and then imagine you put debt on there.
And you hit the ADR of what the actual top of the market is there, right?
And now your upside scenarios become very, 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 very interesting. And I go, okay, well, I put, in this case, 1.5 million in, and I got 9.6 million out. Now I know that's not what you're at all suggesting. I'm looking at the upside. When I look at the downside, I say, okay, let's assume that we don't get any debt. So I'm now putting up 4.5 million, if I understand right, 4.4 million.
4.4,
yeah. And let's say that you don't hit your ADR number. Let's say that it's something closer to 55. And let me just put some big, I don't know, let's add another 150,000. So my expense ratio instead of 44 goes to 50, right? I'm still a 2 multiple over a
beat it up. That's the thing.
I know,
it's
right?
like,
you can beat this thing up like crazy.
Add 10% to your contingency for development, right? Just to play around.
Yeah. Now so if I go to 50, and you can add. Yeah, you're right. And then you take the contingency to 10%. And I just took. I mean, I'm really beating it up. I just took the rent to $50. I mean, even then, I'm still a 187.
Even then, it's like, all right, that wasn't great, but it's a 13, 14, I mean, it's, and that's what I mean.
Take this back to 9.
Starting at the macro, the stories, the demand greater than supply, and here's the attractive pricing. So it's really, I'm extremely excited about this. I feel like we found a great opportunity, and the goal is not to do this, but to do this, not to do this one, but to do this on a national level. There's a lot of national parks out there. A lot of supply-demand imbalance, and what we need to find is attractive pricing. And we talked on another podcast about the team and the sophistication around sourcing and entitlements and approvals that we have in place. So it's exciting. It's really exciting.
Well, I'll say first off, as a friend, I've known Michael now 10 years, 11 years actually.
Right.
I'm excited for you. I wish you well. I think this is really exciting what you're doing with your RV platform. I'll be excited to continue to watch it. And to throw in a few dollars myself when I can to contribute to what you're doing. Either way, best of luck to those that are listening. I hope that you learned something. Michael's a pro, and it's really cool to see for us to dig in, me take the perspective of an LP and dig in and have Michael describe his process, both at the macro level, at the micro level, think about project costs, to think about his pro forma. And so thank you for listening. Even if it was an hour, I hope it was worthwhile. Sam, maybe we'll have you wrap this up.
Yeah, I said this once before, but now I'm going to say it again. That is a wrap for season 4. It was a ton of fun. Man, just again, a bird's eye view watching you guys, go through this model, go through the project, was a ton of fun for me. Very interesting. And to all you guys, hopefully you enjoyed it, like Spencer said. And looking forward to season 5. Every season we seem to kind of up the game. We talked about deal making and deal doing, and then we actually went on site to do it in person. And who knows what season 5 looks like, but I'm looking forward to it. So thanks for watching this season, and we look forward to next.
Thanks for tuning into this episode of the Adventures in CRE audio series. For show notes and additional resources, head over to www.adventuresincre.com/audio series.